Hello and welcome to Finance with Brothers. I'm Ajay Sharma. Today, we're diving deep into the gold market. Why gold remains one of the most precious assets, what is driving prices right now, and how you should think about gold as part of your portfolio. Whether you are a beginner or an experienced investor, this video will give you a complete picture of gold's past, present, and future. Let's start with the current sentiment. In 2025, gold prices have been showing mixed trends. Market sentiment is shaped by geopolitical tensions, rising inflation, and uncertainty about central bank policies. While some see gold as a safe haven amid global instability, others expect a slowdown in demand due to rising interest rates and a strong US dollar. Recent data shows central banks, especially from emerging economies, are increasing their gold reserves to diversify their portfolios and protect against currency volatility. Investors are watching gold closely as inflation concerns and currency shifts keep it in focus. Gold has a rich history spanning thousands of years. From ancient civilizations where it symbolized wealth and power, to modern times where it plays a crucial role in global finance. Historically, gold has been a store of value, a hedge against inflation, and a crisis asset. Even in the digital age, gold's allure hasn't diminished. It's not just a metal. It's a symbol of stability in uncertain times. But why is gold so precious? The reasons go beyond aesthetics. Gold is scarce, durable, and universally recognized as valuable. Unlike fiat currency, gold cannot be printed, making it a hedge against currency debasement. Its ability to retain value during crisis is unmatched, which is why it remains part of national reserves and investor portfolios worldwide. Central banks are major players in the gold market. In recent years, countries like China, India, Russia, and several Middle Eastern nations have been increasing gold reserves. This trend reflects a strategic move to reduce reliance on the US dollar and diversify risk. For example, Russia and China's gold buying is part of a larger geopolitical strategy, protecting against currency fluctuations and economic sanctions. In India, gold has a unique cultural and economic significance. Gold is not only a store of wealth but also an integral part of traditions, weddings, and festivals. Despite global fluctuations, Indian demand for gold remains strong, particularly during wedding seasons and festivals like Diwali. For many Indian investors, gold is seen as both an emotional and strategic investment. Gold has long been considered a hedge against inflation. When inflation rises, the purchasing power of fiat currencies declines, but gold often retains or even increases in value. In today's high inflation environment, gold's role as a safe haven asset is more relevant than ever. Investors looking to protect their wealth often allocate a portion of their portfolio to gold. As of now, gold is trading around Rupee 1,20,000 to 1,25,000. Technically, gold is showing support at 1,14,000 and resistance at 1,14,000. Indicators such as RSI and MACD suggest bullish sentiment. Traders should watch these levels closely. Price movement will also depend on US dollar strength, interest rate decisions, and global geopolitical events. When considering gold as an investment, you have two main options: physical gold and gold ETFs, exchange-traded funds. Both have their pros and cons, and the cost structure is different. Physical gold includes coins, bars, and jewelry. Buying physical gold gives you direct ownership and is tangible. In India, demand for physical gold is high due to cultural importance. However, it comes with extra costs: making charges, storage charges, and purity certification. Making charges for jewelry can range from 8% to 25%, and storage costs can add up if you opt for lockers. There's also the risk of theft and the need to insure the gold. Gold ETFs are exchange-traded funds that track gold prices and can be bought and sold on the stock exchange. ETFs eliminate the need for physical storage and purity concerns. The main cost is the expense ratio and brokerage fees. ETFs offer easy liquidity but require a demat account. For pure investment purposes, ETFs are often cheaper and more convenient than physical gold. So, if your goal is wealth preservation and inflation hedging, ETFs might make more sense. But if you value tangible ownership, physical gold is preferable despite higher costs. Based on your choice, physical gold or ETFs, the asset allocation strategy may differ slightly. For most investors, experts suggest keeping 5 to 10% of your portfolio in gold. For example, if you are going for ETFs, this can be managed easily through monthly SIP. For physical gold, allocation should be weighed against storage and making costs, especially if you plan long-term holding. To sum up, gold remains a timeless asset, a safe haven in uncertainty, a hedge against inflation, and a store of value that transcends generations. Deciding between physical gold and ETFs depends on your investment horizon, cost tolerance, and desire for tangible ownership. Understanding these differences will help you build a gold strategy that fits your portfolio. Thank you for watching Finance with Brothers. If you found this video insightful, hit the like button and subscribe for more updates on gold, markets, and investment strategies.